Do you want to know how the rich get richer and how they're able to build generational wealth even after they've passed on? Well, in our 20th episode of Real Talk, we've got Mr. Craig Brown of IPX1031 sharing his knowledge of how you can save taxes from your investments and put those savings to build generational wealth. All right, Craig, thank you so much for being here. We really appreciate you taking the time out of your day to share with us your knowledge about 1031 exchanges, and we know you're really busy, so thank you for being here.
Well, Jim, thanks for the opportunity. It's my pleasure to be here.
Great. So, Craig, tell us about your company, IPX1031, and give us a little background on who you are and what you do.
Sure, absolutely. So IPX1031 is a wholly owned subsidiary of a big Fortune 500 company, Fidelity National Financial. Their core holdings are title insurance underwriters, so they control about a third of all the title insurance that's issued throughout the U.S. Different brands of insurance companies: Chicago Title, Fidelity Title, Alamo, Lawyers, Commonwealth. So several different companies that everybody in real estate will recognize. They're our sister companies. We're a pure play 1031 qualified intermediary. We do both delayed exchanges, sell first, then buy, reverse exchanges, part title, sell first, then, or sell, then buy from us. Pretty much anything that you can do in a 1031, we facilitate those types of exchanges. This is coming up on year 27 with the company for me.
Wow.
And
27 years. I mean, you're twice over, almost three times an expert, huh?
Yeah, there you go. That's awesome. So it's, I always said if I could use my law degree, keep money away from the government legally, I'd enjoy what I did. And I just love the fact I spent a little bit of time suing people for a living. I hated that. And it's just a great way to help people get deals done, help people keep their money working for them. And so, it's a good day at the office every day when you get to do that.
So what law school did you go to?
Baylor. I'm a Baylor Bear. I chased the baseball around for a little bit in college, little JUCO action,
interesting,
little Baylor action.
Nice.
Yeah. And then Baylor had a program where you could actually start law school early. And, my baseball career wasn't going anywhere. So I applied, got in, started law school. So I've got a funny timeline on my actual graduation. I have a finance degree from Baylor, 1990, law degree in 1991, because I wrapped up my last bit of undergrad while I was in law school because I wanted a finance degree. And so it looks kind of funny on my bio, but
that fits exactly what this is all about. Really, it's law and finance put together.
Right. Yeah, exactly.
Well, and also I know this is all you do. I mean, you're focused completely on exchanges and helping your clients, basically protect their money and make more money.
Right. That's right. That's all we do. We don't try to make a market in replacement properties. We don't do other things. Even though we're sister companies with title, we don't do any title. We work with everybody regardless of where they're closing. A lot of our transactions are oil and gas deals that don't have any type of formal closing. They're more principal to principal transactions. So we're whoever needs a 1031 done, we're there to serve them.
Well, let's get into it. So I really want to break down everything and unpack what a 1031 is and the different options and different ways to go about it. So let's just start from the beginning.
All right. Very good. So the basic concept of the 1031 exchange, where there's this deferral of gain recognition, has actually been around for a long time, since 1921. So almost since the inception of the federal income tax code was this ability to defer gain recognition. Now, it used to really be a swap, right? Two landowners would just want to swap deeds on property, and that's the way it rocked along for a while. No problem. Then we had these, let's call it a buyer facilitated exchange. And I always like to use a real simple example when I talk is, let's sell a rent house, buy a duplex. Now, it may, I tell people all the time, I'm going to talk about $100 sell, and you just put as many zeros behind it as you need to put to get your attention. I've done deals as small as 40,000, done deals as big as $2 billion. So I can we can talk about any dollar value. I just like
I'd
real
love to
simple.
talk about the $2 billion one day.
Right? Right, exactly.
They saved a
Exactly.
lot of money on that one.
They did. They did. But the basic concept of this deferral and this buyer facilitated exchange, and where some people still kind of think 1031 is real difficult. It used to be I wanted to sell the rent house and buy a duplex. I'd have to find somebody who was first willing to buy the duplex and then swap deeds with me for that duplex that I wanted for the rent house that they really wanted. Well, that was real cumbersome, right? So over the course of time, different cases, there is this concept of a sell followed by a purchase, and the Starker case is really the seminal case that kind of is the genesis of the modern era of exchange. T.J. Starker sold a bunch of timber property to a company called Crown Zellerbach. Zellerbach bought over time properties for Starker's benefit. A lot of issues involved in those transactions, but at the end of the day, what we ultimately had was there was nothing in the code that prohibited this delay concept. And then over time, and really through 1991, when we had the finalization of the delayed exchange regs, that's really when the modern era really began. And just a little bit before that, we had the introduction of these time periods, right? So I have a closing of the property, and so truly it's the shift in the burdens of benefit of ownership off of the relinquished property, the property that the taxpayer currently owns that they want to sell or they want to get rid of. From that closing until the closing of the last replacement property, the replacement property being that property that the taxpayer wants to acquire and ultimately own indefinitely out into the future, that whole period can be a total of 180 days. Now, there's some, legal language. It's the lesser of the tax return due date or the 180th day. So if like you have a closing December 1, 2023, for the individual taxpayer, they're going to hit their tax return due date April 15th, 2024 before they hit day 180. So they have to have their 1031 exchange completed by April 15th, 2024. However, they can file for an extension of that income tax return. That's an automatic right to an extension. So their new due date for their tax return will now necessarily be after the 180th day. So you can always get to 180 days, but sometimes there are situations if you don't extend your income tax return, then you could have to have it done before that. Now, the other critical time period, I know we'll talk about this a little bit more, but this is kind of just the 10,000 foot overview and the history of 1031. The other time period, it really is the one that's a little bit more difficult, is the first 45 days of that 180-day exchange period are also known as the identification period. That's when the taxpayer has to identify. They have to put in writing. They have to sign it. They have to be site specific. They have to deliver it preferably to the qualified intermediary, but any non-disqualified party that has responsibility for transferring the property. So they could identify to the seller, but they have to make this formal identification by midnight of the 45th day. And after that point in time, they can't change any of their identification. So 1991, we have the finalization of the Treasury regs that kind of put all this into place where it really creates this safe harbor where the IRS is saying, okay, follow all these rules, and we're going to take a hands-off approach to challenging these transactions, right? And so we want you to, identify within 45 days, close on the acquisition of replacement property within the balance of 180 days. And that kind of launched us off into what we have today.
So, and you mentioned, you briefly talked about like the 45 days, which is the most challenging, and that's identifying. You've got 45 days from the day that you close on your property that you're exchanging for the next property to
That's
identify, right. And how many properties can you identify
Yeah, I'll talk about that. That's a good question. Let me say one other thing just to kind of solidify when the starting point is, because sometimes there can be confusion. It's the closing of the first relinquished property that is part of that particular 1031 exchange. And so in a particular exchange, let's call it exchange number one, you could have one relinquished property, one property being sold, and you could have one replacement property. You could have one relinquished, and you could have several replacements. You could have several relinquished and one replacement, several relinquished and several replacements. But whatever the first relinquished property is that is sold as part of that exchange, that's day zero for the 1031 exchange period. So you have to have your last replacement property closed in exchange number one by the 180th day. Okay. So now kind of that launches us off into how many or how much. And the reason that I say that is there's two basic rules for identifying potential replacement property as far as what I can put on my list. The first rule, the most common rule utilized, is called the three property rule. The three property rule says that I can identify one, two, or three potential replacement properties with no cap on the aggregate fair market value. So if I sell a $100 property, I could identify a $100 replacement property, a $300 replacement property, and a $500 replacement property as part of that 1031 exchange. And under the three property rule, I'm perfectly fine. That's a great, valid identification. Now, ultimately, I can close on any one, any two, or all three of those properties as part of that 1031 exchange. So that's the three property rule. Limits the number, unlimited fair market value that can be on the list in those properties. Okay. So
Yep.
then if you go ahead.
No, that's right. Okay.
Okay. And so if you wanted to put a fourth property or a fifth property, if you wanted to put more than three properties on your identification list, now you have to switch over to the second rule, because necessarily you have more than three, so you don't satisfy the three property rule. So now I have to satisfy the second rule. The second rule is called the 200% rule, because it puts a cap on the total fair market value that you can identify. So if I sell $100 of real property on the sell side, and I want to identify 4, 5, 10 potential replacement properties, my entire list, when I put everything on my list and put my estimated fair market value next to each one, that sum, when I total it up at the bottom, it can't be greater than $200. That's why it's called the 200% rule. $100 gross sales price, $200 maximum dollar value. Now, it's real important to understand the 200% rule, that does not come into play if you identify three or fewer, right? So it's only if you're identifying four or more does that 200% rule actually ever come into play, okay? So most exchangers use the three property rule. On occasion, when you have a taxpayer that's selling a high dollar asset and they want to buy several smaller dollar assets, then that's when they'll utilize the 200% rule, okay? Now, I said there's only two rules because there's only two rules, but if you violate both of those rules, you essentially are deemed to have nothing identified. It's not a valid identification. However, you can still swoop in and save the day. It's called the 95% exception. So if I violate the three property rule and I violate the 200% rule, so I identify more than three, I identify more than two times what I sold for, I can still have a valid exchange if ultimately I close on the acquisition of 95% or greater of the fair market value that I had actually put on my list. Okay.
Okay.
Now, that's not something that comes up very often. And the only time that it really should intentionally come up is if you're buying a portfolio of properties, right? I'm
Right.
going to sell for $100. I'm going to buy 10 properties that cost $1,000, greater than three, greater than two times, but it's an all or nothing package. I either close on the acquisition of all 10 properties, dog or no dog, or I close on none. So in that instance, I know with certainty I'm either going to have a totally tax deferred exchange because I'm going to go from 100 to 1,000. I'm going to roll all my cash over. Oops, I'm in a green building, and so if I don't move enough where the switch can see me, it turns the light off.
Don't.
So if I don't, if I buy the full 10, then I'm golden, right?
Right.
If I end up not buying any, then I'm going to pay my taxes and get on down the road. So that's the rules for identification. 3 property rule, 200% rule. Violate both the rules, I can still have a good exchange if I satisfy the 95% exception.
But yeah, I guess most people are probably in that 3 property rule, and I doing most of the time. I mean, at least in my experience, is we're identifying property before we even start to sell the other property, which is completely fine. Is identify. Right. The only issue is if you could lose some of those properties in the meantime, so you've got to make sure you tie up a few and then identify the 3 that you may potentially take, and you could buy just one of those.
Absolutely. And there's a couple of points to illustrate in that. Is one, you can contract for property anytime you want. There's absolutely no prohibition about contracting. Those dates don't matter at all. It's closing. It's the shift of the burdens and benefit of ownership out for the relinquished properties, or the shift of the burdens and benefit of ownership in for the replacement properties. So you can contract for property anytime. That's perfectly fine. Now, you cannot change your properties on your identification list after midnight of the 45th day. So by midnight of the 45th day.
So you can change, like if I sold the property that I'm going to relinquish, and then I've got 45 days, I can change that all, as many properties. I can go back and forth, and then just by the 45th day, I've got to have those 3 identified.
That's right. That's exactly right. And so typically what people do, they'll kind of wait later in the identification process, because in their due diligence of what they're going to find to buy, they may have 10 properties that they're looking at, and at day 20 they eliminate 3 of them, so now they got 7 that they're looking at, and then they whittle that down till day 40. Now they kind of know what their 3 properties are going to be, so they shoot us over a list, and then day 42, the property of all properties comes available, and so they revoke, and the rules have specifically how to properly revoke an identification, and then re-identify. So they would have, let's say property A, B, C on the list, property D comes available that they want to substitute out. So now the list is A, B, D. They properly revoked the first identification. On day 43, they submitted the last identification. And then on day 46, if something else comes up, too bad, they can't change it.
Right.
So that's what you're looking at.
And it sounds complicated, but it's actually not that many rules. And when you're working with somebody like you're going to guide everybody through this process. So it's not that overwhelming. It's pretty simple.
It really is. There's a lot of things that go into a 1031, but on the street, what it is I've got to sell something, and I have to identify what it is that I'm going to buy, and then I have to get it closed within a certain amount of time. That's really what you're looking at. And I do want to mention one thing, because we're talking about, identifying property, buying property, and all that. And one of the things that I like to talk to people about at the very beginning, when they call up and they're starting to tell me their story about what they're going to sell and what they want to do, one of the important things to understand, and you know this because you're the one that's helping them write out the contract, is who the actual owner of the property is, right? That's critical. And so you have to know who is selling the property. Now, most transactions, the owner that shows up in the deed is actually the same owner for federal income tax purposes.
Okay.
There are instances when that's not true. The most common of those instances is in the use of a single member LLC, a limited liability company that has one member. By default, that limited liability company, that LLC, is disregarded. It doesn't even exist as far as the IRS is concerned. It may even have a federal tax ID number so that it can have a bank account, but it's still not an entity, not a taxpayer, I should say, not a taxpayer for federal income tax purposes. That sole member is the owner, is the federal income taxpayer, assuming it's not also a disregarded entity. Sometimes you see these big long stacks of disregarded entities. But that LLC that's owned by Sally is the federal income taxpayer, even though legal title is held by the LLC. So one of the basic things in 1031, we have to have the same taxpayer sell and buy. So Sally can sell, Sally can buy. Sally's disregarded LLC can sell, and Sally can buy. Sally's disregarded LLC could buy, or Sally's new disregarded LLC could buy.
So it's following the taxpayer, and I guess for a single member LLC, it would be, that the tax gain is what we're trying to defer. That's going to follow the whoever is going to be responsible for that tax. But if it's an LLC with multiple members, now it's going to follow that LLC.
That's exactly right, because that LLC with multiple members is either going to be taxed as a partnership or a corporation, right? So that would be a actual taxpayer.
So let's back up, and I've got a few more questions about that, but I want to go back to, let's break down, an example of why somebody would do this, and let's use $100 property and explain to our audience, like, what is the purpose, the true purpose? What are we saving or gaining?
Right. Why do we even need to talk about this, right?
Yeah.
So the way it comes up, and kind of the example I like to use, let's say I go out and I buy a property for $100. It's fresh cash. I go out and buy a property, or cash plus debt, whatever. This is a new property to me. I buy a property for $100. And over the course of time, and let's just say it's a rent house. And so over the course of time, that property appreciates in value to $150, and I'm going to sell it now for $150. So real easy to see, I have $50 of gain from appreciation in value. The property went up in value, okay? But what I also have, and what some people don't realize they have, is that property, when I paid $100 for it and started renting it out, I was able to take depreciation on that property every year. And so maybe my initial cost basis of $100, that was my cost to acquire the property, maybe it adjusted down to $80. So now when I sell that property for $150, I don't just have $50 of gain, I have $70 of gain. And
that's because you're depreciating that asset. If it's residential, it's 27.5 years. So if it's 100,000, so like, you've got to take that into account to calculate what your basis is.
Right. And that saves you money. That depreciation, some people say, well, should I take depreciation? Absolutely. Because that saves you money every year, right? So you get to take that depreciation deduction, and so that means you're not having to pay in that year as much in income tax as you would if you didn't have that depreciation. So that's one of the great benefits of owning real estate, improved property, income producing property. And then the arbitrage of that is you're writing it off at a higher tax rate than you have to recapture it. Because now when I have to come back and pay tax, if I sell for $170 and I have 50 gain from appreciation in value and 20 gain from depreciation, I have to pay a 25% tax on that 20 of depreciation. I'm going to pay a 15 or 20% tax on the gain from appreciation in value. But I wrote that depreciation off at a higher tax rate than what I'm having to recapture it at. So, that's a win. That's a win in and of itself. Not only did I get the time value of that money that I didn't have to pay in income tax over the years. It was a rental because of what I saved on depreciation. When I have to pay it back, I'm paying it back at a lower rate than I deducted it at.
So you take that into account. You sold your property for 150, but you add that depreciation. So really, your gain is 70,000.
That's right.
So now what?
So now I've got this 70 of gain, and so to have a totally tax deferred, and let me go back. I gave you some numbers. 25% tax on the gain from depreciation recapture, 15 or 20% tax. That depends upon your taxable income. Okay. And that's a progressive tax. So the first part of that $50 of gain from appreciation may get taxed at 15%. And then I may trip through that taxable income barrier that causes the last part of that 50 of gain from appreciation and value to get taxed at 20. So there's two benchmarks that CPAs or tax advisors will explain to their clients when they're doing their tax return on these exchanges is once you trip through a certain level of taxable income, your capital gain rate goes from 15 to 20. Once you trip through a certain level of a modified adjusted gross income, you get the privilege of paying the net investment income. Some people call it the Obamacare tax, that 3.8% tax. So that could attach to the depreciation recapture. It could also attach to the gain from appreciation and value. So wealthy taxpayers are really looking at a 23.8% tax rate on gain from appreciation and value at the federal level, and 28.8% tax rate on recapture of depreciation. And most states, not all, but most states have a state level capital gain tax or state level income tax that's going to layer on top of those federal rates. So, California is probably the highest. California, New York, Pennsylvania, or Philadelphia. Pennsylvania has some even local local taxes. But yeah, so those are the highest tax areas. But so that's the gain on that appreciation in a 1031 and the gain from the depreciation. Both can be deferred in a 1031 exchange. So our example is we've sold a property for $150. And let's assume for the easiest example, I have no debt on that property. So at closing, $150 sell, zero debt. Let's ignore closing costs just for this discussion. That means $150 is going to come in to me as qualified intermediary. The taxpayer then is going to make their identification like we previously talked about, and they're going to go close on the acquisition of replacement property. Well, if they close on replacement property that either individually or in the aggregate is $150 or greater, and they utilize the entire $150 that I'm holding, then they'll have a totally tax deferred exchange. So if I sell a rent house for $150 into the QI, $150 out to buy the 300 duplex, I've rolled all my cash in, and how I make that difference up on that other 150 that I need to buy the 300 duplex, it doesn't matter. Yeah. It could be cash out of my pocket. It could be a loan. It doesn't matter how I do that. Totally tax deferred exchange because I bought equal or greater in value. I reinvested my cash. In this example, I had no debt relief. Okay. Now,
yeah. So, I think to back up, the important part, you mentioned it, you can't, you're not going to be closing on a transaction, collecting the money or the profit or any of the proceeds, and then calling a 1031 intermediary like yourself, and then trying to do the right. It's always got to start with the 1031, and before you close, the money can't go to the seller. It has to go to a 1031 intermediary.
Exactly right. And so mechanically what you see happen is typically somebody will list a property for sale. Their realtor will talk to them about, marketing that property and what their goals are for anything else that they may want to purchase. 1031 may come into the picture, and they'll have an initial consultation with the qualified intermediary. That property gets marketed, and when an offer is accepted, then that 1031 qualified intermediary will ultimately want a copy of that purchase and sale agreement, that contract. And it'll ultimately want a copy of maybe the deed or the title commitment, so that it has the information that it needs to draft the 1031 exchange document packet, right? So all that has to take place before closing. That 1031 exchange document packet will need to be executed either before or at closing. And part of it is a notice that has to be given to the buyer. So that's going to have to be presented to the buyer. Most of the time that takes place at closing. It could be done in advance, but most of the time it takes place at closing. So then at closing, those monies are sent to the intermediary. Now, why are they sent to the intermediary? One, because that's the rule, but legally, why do they get sent to the intermediary? That 1031 document packet has to have 3 core documents. One is the exchange agreement, and that exchange agreement is the agreement between the exchanger, also we call them the taxpayer, right? The taxpayer, the exchanger, and the qualified intermediary, okay? And it must contain certain specific language that comes out of the Treasury regulations, commonly referred to as the G6 language, right? Treasury Reg 1.1031 K1 G6. It's kind of the magic language of the delayed exchange, where you get to sell first, have this delay period, and then purchase. It's got to have that language in that agreement. Second is an assignment. It's an assignment of that taxpayer's right to sell that property in favor of the qualified intermediary. So one of the things that we suggest is that there's some boilerplate 1031 language in the contract, something that says, notwithstanding anything else in the contract, this contract can be assigned to a qualified intermediary for the purpose of facilitating an exchange. You know, no cost, no delay to the buyer. Just some generic language that goes in there. Because even if the contract says that it's not assignable, if you have this provision that says, notwithstanding anything else in the contract, we can have the limited type of assignment that's needed for the 1031 exchange. Because that's a critical element of the exchange agreement with the G6 language, an assignment of the right to sell, notice to the buyer. We're talking about the relinquished property. You have to have notice to the buyer, right? Then there's going to be instructions to the title company, the attorney, the escrow. It depends on where you're at in the U.S. as to what that person is called. But the person that's going to facilitate the closing of the real estate transaction. Okay. And so when that takes place, all those documents are in place to tell that closing person that now that money is supposed to be sent to the qualified intermediary, right? Now, if the taxpayer wants to we're selling a property for $150. If they want to take $10 at closing and pay tax on that $10, that's great. What they assign to us as intermediary is the right to sell 123 Main Street less X, $50, $10, whatever, $500,000, whatever the number is that they want to take. They're going to pay taxes on it, but they can take that at closing.
Okay, well, that's a new concept I didn't realize was possible. So you can do a 1031 exchange, sell your property, and if we're selling it for $150,000, and I've got let's just say $50,000 in gain, and I want to keep $10,000 of that $50,000, I can do that and just pay taxes on that $10,000.
Exactly. So in that scenario, if I do that, so if I sell for $150 and I reserve out of my assignment that $10,000 at closing, I'm going to get $10,000 from that sale, and the qualified intermediary is going to get the $140. Remember, our example had zero debt, just to make it real simple. So I'm going to get 10. Qualified intermediary gets $140, and now my numbers are: I can't ever get a totally tax deferred exchange because I took some cash. But to maximize my 1031, maximize my deferral, you said we had 50 of gain. Okay, we had 50 of gain. We took 10 of that in boot. That's what it's called, boot, in the form of cash. So we call it cash boot. So now I've got $140 on with the QI. I buy a property for $140 or $200 or $250, I'm good. I tell the queue, I send the whole 140 out to buy that replacement property. It's a qualified replacement property. Totally great. At the end of the day, I have $50,000 or $50 of realized gain. I have $10 of cash boot. I pay taxes on or recognize the lesser of boot or realized gain. So in this example, I pay tax on the 10. I deferred taxes on 40. So I had 50 of realized gain, ended up only having to pay tax on 10. I deferred taxes on 40. That's a good day, right? It's a partial deferral. It's a good day.
Well, that's great. And I just complicated everything. So but that's the first time I've heard about the boot. And that's very interesting. So let's simplify this for everybody. Sure. We've got a property we bought for $100. We got $50 in, we're selling it for $150. To explain to us the rest of that process in very simple terms.
Sure. So that 50 of gain from appreciation in value, and then in our example we had $20 of depreciation. So I've got 70 of realized gain. And so to have a totally tax deferred exchange, I've got to.
And let's go back. Let's assume we sold it for that, and we had $70 of realized gain.
Yes, sir.
We would basically be paying taxes on that gain of $70. Right. So by doing the 1031, we're just going to defer that. We're not going to pay any taxes, and we're going to be able to get that benefit, but we have to purchase the next property.
That's right.
Yeah.
So to have a totally tax deferred exchange, I have to roll over all my cash, all the cash from the sell side. I have to offset any debt relief. In this example, we had zero. Okay. And I have to buy necessarily property that costs equal or greater in value. Okay. And it has to be like kind. Now, like kind just means it's real property held for investment or productive use in a trade or business. So we're talking about sell a rent house, buy a duplex, perfectly fine. But it could be sell a rent house and buy oil and gas royalty interest. That would be perfectly fine as well. Okay. But we're going to keep it simple. Sell the rent house, buy the duplex. We'll talk about like kind a little bit later, right? So to defer that gain on the 50 appreciation in value, the 20 of depreciation, if I buy a property for 150 or greater and reinvest all my cash, totally tax deferred exchange. Okay. So we're good there, right? Now, if I buy a $200 replacement property, I start out with my basis. We'll call it a substitute basis. My basis in that replacement property is going to be 200 minus the gain that I deferred, 70. So initially my basis in that property is 130. Okay. So I have 130 basis. Now I'll set up my depreciation schedule and everything else based on a 130 basis in that property, not a 200 basis in that property, because I didn't have to recognize that gain. So the government's not going to give me a double plus, right? Let me defer the gain and still get full basis.
Right.
I'm going to have the substitute basis. So 1031 is an event. Once I buy that replacement property, my 1031 exchange is over. Once I hit, it's completely done. And it's just an event. And that's why they use this method of substitute basis, is so you don't have to track everything back. You already have built into your replacement property everything that needs to be known, so that if some point out in the future you sell that property, you're just having to work on that property, right? What are the economics of that particular transaction? So that part works. That part works well. So I'm deferring that gain. Now, let's go back and tweak our example just a little bit, just for illustration purposes, because a lot of people do not understand that they have to offset the debt relief. So our first example was selling for 150 zero debt. Let's do 150 with, let's just say, $50 of debt. Okay, so at closing, I've got 150 sell price. The mortgage of 50 is going to be paid off. So now the 100 comes into the qualified intermediary. If all that I do is buy a replacement property for $100, I take my $100 of cash, I buy a replacement property for $100. Okay, I go through my total analysis of what we talked about earlier. Still had the same example, 150 sell price minus, or I had 50 gain from appreciation in value, 20 gain from depreciation. So I still had the 80 basis. 150 sell price, 80 basis, 70 of gain. Okay, so I'm gonna kind of put that number to the side. I know my realized gain is 70. I'm gonna set that number to the side. Now I'm gonna look out and find out how much boot did I have in this transaction. I sold for 150. I only purchased for 100. So I had $50 of boot. And what is that $50 of boot? That's the $50 of debt that was paid off that I didn't offset on the buy side. I didn't buy a corresponding property to offset that debt relief. So at the end of the day, I had $50 of debt relief that I didn't take care of. Did I reinvest all my cash? 100%. I'm great on that aspect. But did I offset my debt relief? No. So in that particular example, I would have to actually pay taxes, recognize gain on 50. I had 70 of realized gain, 50 of boot. I'll pay tax on the 50. So I still had a partial deferral, but I only deferred on the 20.
Right. So, yeah. I mean, to simplify it, if you've got, you just have to reinvest everything plus your gain has to be reinvest in order to benefit from a complete total deferment.
That's right. I kind of talk to people about two buckets, right? I got a debt relief bucket and I got a cash bucket. When I sell a property, most people don't own their properties free and clear. So when they have that sell transaction, that event, they have two buckets they need to be concerned about. One is the debt relief bucket and the other is the cash bucket. Now the cash bucket's sitting with the QI. Right? That bucket's sitting with the QI, but the debt relief bucket, they know they've got to offset that also. So I'm going to send $100 of cash out, but they still need to buy a property for $150 or greater to achieve a total deferral. So if they have a $200 replacement property they want to buy, and I'm going to fund $100 to that acquisition, they've got to make that other $100 up however they want, right? Cash out of pocket, debt, or a combination of fresh cash plus debt. Sorry about that.
You're not moving enough.
So fresh cash plus debt. Okay, so it's always the kind of the core conversation is reinvest all the cash, offset the debt relief. And we say offset the debt relief because if I pay $50 of debt off, I don't have to have $50 of debt on the buy side. I could elect to pull $50 of cash out of my pocket and add it to the $100 that the QI has and pay cash for that replacement property.
Right.
And then what I'm going to do is once everything's all cold and over with and seasoned, then if I wanted to, I would come back and I would borrow against that replacement property and pull cash out on a tax-free refi.
Right.
So sometimes people will go all cash on their replacement property because they know at some point in the future, in the near future, they're gonna refi that property and pull that cash out, and they don't want to have two loans. Have a loan to close it and then have a refi loan afterwards. So it's just there's all kinds of ways that you can maneuver that. Right.
Yeah. So and I know there's some other mechanisms that you can use, whether it's like doing a reverse 1031 where you're buying your property. I think we really hammered it down. If you've got a property right now, to simplify it, $100 property you bought and you sell it for $150, you've got some depreciation that you've already gained, so $70,000. You've just got to replace that once you've got that $150 in order to defer all the gains, but you could buy a $500,000 property and then input this that same the whole $150 into a $500,000 property, or up to 3 different properties without going into the other rule. So now, before we get into some more details, I think that is the essence of why some of these wealthy people are doing it. Let's talk about that. Like, why would somebody do that? Obviously, to save taxes currently. But eventually, if they sell the property in the future, they're going to realize those taxes. But how does that help build wealth for these wealthy individuals?
Yeah, so one of the core examples that I like to tell investors when I talk to investors is this concept. And I learned it back in business school, the rule of 72, right? The rule of 72 tells us how often money doubles. So if you borrow money from somebody, that works against you. But if you have money invested that's earning a return, that works for you. It's that compound interest. And so, I like to have easy numbers, right? And so I can understand the concept of a 10% return, dividing that into 72. That means every 7.2 years, my money's going to double if I have an investment that's making me 10%. A 10% return on the money invested is not unusual, especially in 1 to 4 family real property. And it's not always unusual in commercial property. But for illustration purposes, you think, okay, if I have to pay $50,000 in tax liability on the sale of a property, let's say I have a $350,000 rental property that I'm selling, and the tax liability on that, when I have to recognize the gain from depreciation and appreciation, is $50,000. Well, if I give that $50,000 to Uncle Sam, that $50,000 no longer has the ability to work for me. But if I do a 1031 exchange and I get to hang on to that $50,000, then if I leverage that up, or even if I don't leverage that up, if whatever I do makes me 10% on that 50, then 7.2 years after that, that 50 becomes 100. 7.2 years after that, so we're about 14 and a half years down the road, that 100 is now 200. 7.2 years after that, so a little more than 21 years later, that original 50 has gone from being worth 100, 200 to now 400. So if I'm an investor for 21 years, 22 years before I hit, quote, retirement age, my net worth, if I've done these exchanges and gotten that original $50,000 to work for me for that 21 years at a 10% rate, that $50,000 has turned into $400,000.
Yeah,
So
that
when I,
it's
when I give Uncle
exponential.
Sam, yeah, right, exactly. So when I give Uncle Sam $50,000, am I really giving Uncle Sam $50,000, or am I giving him $400,000 that I would have been able to use 20 years later?
Right.
So that, that's just a huge deal, right?
Yeah.
That's you want to keep that money working for you. Now, I go to DC, probably at least once a year. We talk to members of House Ways and Means, Senate Finance, other members of the House and Senate, and we talk to them about the benefits of 1031. We have some fantastic. If somebody is really in the weeds and wants to understand all the economics, we have some fantastic studies that were done by Professors Ling and Petrova, by Ernst and Young. I mean, just great studies that show the significant positive impact of 1031 on the economy in general. Now, they don't like it, but there's a rule called a stepped up basis, right? So if an owner owns a property, any assets, if they own it, their basis, when they pass away, their basis steps up to the fair market value at the date of death, right? And then if their estate is large enough, there's estate taxes that have to get paid, but this step up in basis. So not very many people do this, okay? And that's what the studies show. But some people will do what we call swap till you drop, right? Is you defer, 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 own that last asset that you're going to own, and when you pass, the basis steps up to the fair market value at the date of death. So here's the absurd example, right? Taxpayer owns $1 million of property. That's all the assets he has. $1 million of property has $100,000 basis. If he were to sell that $1 million of property the day before he died, he would have to pay taxes on $900,000 of gain. But if he doesn't sell that property, The day after he dies, his heirs can sell that property for $1 million, and now in their hands, that property has a stepped up basis to $1 million, fair market value at the date of death. They sell it for $1 million, basis $1 million, zero capital gain. The $1 million estate is under the exclusion for estate tax, so there's no tax that has to be paid. Right? So sometimes people will utilize 1031 exchanges as part of their estate planning on some of their assets. So that's one, to get the stepped up basis. Another way that it gets used for estate planning is, let's say that you have a client that's been very active in their real estate management, right? And they have 3 kids, and the kids are not active in the real estate management at all. They're just not into buying and selling real estate, and and making that their business, right? And so that taxpayer says, you know what, I want to pass on my wealth to my kids, but I need to do it in a way that's going to be passive to them, right? And so they may decide to sell their real estate portfolio and buy 3 single tenant triple net lease properties, right? They may decide to go buy a McDonald's, a CVS drugstore, and they may buy a bank branch, right? They own the land and building and all of those. The operator pays them monthly income. So now when that taxpayer dies, he can leave each of his 3 kids one of those assets. So that's a way that people utilize 1031 exchange. But
that's a very interesting. It's a great, not only is it to build up the wealth, but it's also to keep it when you do pass away, to give it to your family. Now, I guess if I had and you may be able to answer this, let's say I had $500,000 worth of real estate that I did not do any 1031s on, and when I sell it, when I die, is it worth $500,000, whether it's a 1031 or not? The basis, I mean, the fair market value.
Yeah, fair market value. Because remember, when we do a 1031, remember it's an event,
right?
So we have that substitute basis, kind of build that all in there. And so whenever somebody passes owning an asset, whether that asset had been part of a 1031 or not, it's treated exactly the same.
Yeah.
Right? If it had been acquired with a 1031 or not.
But the benefit is to get that that money working for you over the next 20, 40, 50 years, and build it up, and then now your family, when you pass, it's at a basis at that point where there will be no taxes on any gain.
Right. That is true, and not everybody utilizes that. Not everybody utilizes that fully, but that concept is out there. But one of the really important parts to understand about 1031 exchanges is it's one of the few things in the tax code that is completely agnostic as to someone's economic situation, right? In the sense that there are parts of the country where a very nice rental home, maybe it's a 2-bedroom, 1 bath, maybe it's a 3-bedroom, 1.5 bath, whatever, still can be obtained for $60,000, $75,000, right? And 1031 is a mechanism that the cost to do a normal 1031 exchange is not such that deferring $10,000 or $15,000 of tax is not beneficial to do a 1031, right? And so there may be a $1,500 fee. Somebody's going to have a transaction that they would owe $15,000 of cash. They're going to pay $1,500 to not have to pay that $15,000 of cash. So they're $13,500 ahead of the game. And so you go 13, 26, 52, 104, right? So even for the little mom and pop starter investor, it's still a big deal.
Yeah, I'm glad you brought that up, because I think, once you do a 1031 with Craig or, whoever you do it with, it's going to start to simplify and make a lot more sense. But what you just said, I think, is the essence of a 1031. Like, I've had people that I've met with, investors, say, look, I really, my goal is to, own one day, a $10 million apartment complex. Well,
Right.
I don't know anybody who saved up, $2 million to buy a $10 million property. What they do is they start. I mean, most investors started as that mom and pop. And just to maximize that investment, this is how the rich get wealthier, is they utilize that money that they're saving, and they continue to, buy bigger and bigger. It's always a trade up. I'm sure that, the $1 billion deal that you did, that wasn't their first 1031. They didn't save up 20% of $2 billion to buy that. It's a way to get into the game and then to trade up until you
Right.
do have, as big as you want to go. But, I think that's a misconception of, investors, who own apartment complexes across the country or anything, is
Right.
I want to own an apartment complex. They're not saving up 20% of the price of that. They've bought smaller properties, and now they've graduated, and just, it's the rate at which they do that, which is going to be, the only variable.
That's a fantastic point, because you're not going to go throw $300,000 or $400,000 into your very first real estate deal that you're ever going to own, a multifamily deal that you're going to do by yourself. If or like the example that you said, the $2 million apartment complex or $5 million apartment complex, that's not going to be the first deal that you do by yourself. Chances are, if that's your very first deal that you're going to do by yourself and you're solely responsible for that, it's probably not going to be a real good outcome, right?
Right.
You better have had some skill in ramping up to that, or you better have someone that you're paying that has that skill set that you can also implicitly trust with your money to be able to manage that asset for you. And so, huge point is, this is the way that most people grow wealth, is it's incremental growth of wealth. You see lottery people that win the lottery, they don't hang on to it because they don't develop the skill set along the way to manage that money, or manage the people that are managing the money for them. It's a huge concept. And we've talked about predominantly what we focused on is real estate investors, right? But another huge segment of my business is business owners. The guy that owns the mechanic shop, the lady that owns the florist shop, right? She owns the land and building and runs, might be a lady that runs a mechanic shop. I don't want to
Sure.
put people
Right.
into categories. Anybody can do anything, but I'm talking about business owners that have grown their business over time, and maybe now it's time to move from a smaller location to a bigger location. Maybe it's time to sell location number one and buy two new locations, right? But there's so many people that I have that are tradespeople that have built their business and own their locations, and now as they sell part of their business, or they sell their entire business, now they're taking that money and they're going and doing different things with it.
Right.
All different types of
Well, I think
things.
that's the most important part of this, this session, is really, this is a step in, and once you get into it, it gets easier and easier. I know I'm blowing over our time, and I know you're busy, but I have a few more questions I want to ask, and
Sure,
I'm getting a little
absolutely.
bit into the weeds, but we talked about $100 property
Right.
that's gained, that we're selling for 150. We've got and then we have a depreciation of 70, so that's um, a $70,000 gain. How does improvements cost on that property affect that gain?
So great question is, so if I go in and I buy a property for $100 and I do capital improvements, that causes my basis to adjust up, right? So if it's a 2 bedroom, 1 bath, and I add on a third bedroom and a second bath, that's a capital improvement. So the money I spend to that adds to my basis, right? Let's say a tornado comes through and damages the property, and I collect $50,000 in insurance. That causes my basis to adjust down. But then when I do the work, it causes it to adjust back up. So there are other things that can make basis adjust. So that's why the correct term that you say is you have your gross sales price. Let's say our gross sales price is 165, and I have ordinary closing costs of 15 to get me down to our 150 net sell price. That's the number I'm keying on for 1031 purposes. Those ordinary closing costs can come off the top. So when my example is 150, I'm assuming I'm talking about net sales price 150. 150 minus adjusted basis tells me how much realized gain I have. That's the amount that I'm going to have to recognize or pay taxes on if I do nothing. If I buy nothing, I'm going to have to pay taxes on that amount, right? So I set that number to the side. I know what that number is, and I look and see what is my adjusted basis in that property. So now when I go analyze what it is that I want to buy, I know that I don't begin to have any deferral whatsoever until my replacement property cost more than the basis of the property that I sold. So in our example, we had a 150 net sell price. We had 50 gain from appreciation, 20 depreciation. It's 70 of gain. So 150 minus 70, my basis was 80. So if I come over and I buy $81 property, replacement property, I'm only going to defer gain on $1. The amount I bought above that basis, assuming I, do other things right. I'm going to have a deferral of $1. If I buy a $90 property, I'm going to defer taxes on $10. I bought above my basis, right? Now I know I got to get to that 150 or greater to have a total deferral, but between 80 and 150, I'm in that zone of partial deferral. Okay. Now I can have a partial deferral other ways as well by pulling cash out, like our $10,000 example earlier. But the core analysis is when I'm buying in that 80 to 150 zone, that's where I can have a partial deferral, right? That's the best I can do. If I buy replacement property in that zone, the best I could possibly do is have a partial deferral. By 150 or greater, I can have a totally tax deferred exchange unless I pull some cash out of the deal, right? So that's the core analysis. So when I talk to somebody, very few people know what their basis is. So when we first talk, we just kind of get a ballpark. Hey, what'd you pay for the property? Do you remember? How long have you owned it? That type of thing. And we'll just pick a number for illustration purposes, and we'll build an example just like we've done today. We'll build an example when we're talking to them and say, okay, in this zone, if you buy in this zone, you're looking at partial deferral. You got to get equal or greater to have a total deferral. Now, we're not going to drill down and tell them exactly what their taxes are going to be, what their exact tax rate's going to be. That's not our role in the transaction. That's the CPA or the accountant, for them to do. But to have a discussion about, is this going to be worth your while? Then we got to have a little bit of idea about how much gain they're going to defer.
Right. Well, and then I wanted to circle back one more thing. We talked about when you're doing a 1031, you need to have certain clauses, or you should have certain clauses in your purchase agreement, or disclosures to the right, whether it's a seller or the buyer. I just want to be clear on that. There's no negative effect to the other party that's not part of the 1031, is there?
No, there's not.
Yeah.
No, in almost every 1031 clause, there's no promulgated clause, right? There's nothing that's an official clause. So every 1031 clause that you see is going to say there's no cost or no delay to the other side, right?
Right.
To the person that's not doing the 1031 exchange. Now, you're talking about really, really, really in the weeds stuff here. On the sell side, when I'm selling a property as the seller, throwing that cooperation clause in, we suggest boilerplate, have a 1031 clause. Doesn't hurt. If you don't do a 1031, it didn't hurt anything. Yeah. If you're going to do a 1031, then it's there. If you don't have a 1031 clause, but the contract has no limitation on its assignability, then you're fine.
Okay.
Because remember the mechanism, I just have to be able to assign the contract. But why leave it up to that?
Right. Just add it. Yeah.
Just throw a clause in. Now, I have seen people get into some discussion about on the replacement property side, right? And this is where you kind of get into the art of negotiation instead of the science of negotiation. There are people that in some circumstances believe that if I disclose that I'm in a 1031 exchange, the seller may take a position of, well, I'm a property that they want. They're in a 1031. They have a limited list. That's why we suggest it's just boilerplate in all your contracts. You're not trying to add it. It's just always in your.
I agree with that statement. You know, we negotiate thousands of deals, and absolutely, if I know that the other party's got a 1031 and they've already identified us as a potential property, I mean, the negotiations go way smoother typically. So, but you can always just do it after you go under contract. Go under contract and then change the addendum, or you can look at it the other way.
Right.
You know, if you're in a limited inventory market and you've got a 1031, that's going to make you look 10 times better to me.
Absolutely.
And so, yeah, you may, it shows that you're a more powerful buyer than somebody else because you got to close.
That's exactly right.
So it just depends on the market and how you want to present the offer. In my mind,
that's right. That's why I call it the art of negotiation, right? Because you, in your position, that's one of the things that you know about the market and you know about, the seller is the fact that my guy's sitting in cash ready to go. Is that a plus in this particular situation? Maybe it's something I want to disclose right up front and to say, hey, look, we're ready to go. We're in cash, got cash with the QI. Now, I typically tell people boilerplate language in the contract, don't disclose whether you're in an exchange or not, right? That's the art part. So I like the boilerplate language in there. Some of the entities that promulgate contracts have now started to add a checkbox or something in their contracts that have some basic 1031 language, but So.
But I wanted to just stress on that point. It doesn't affect the other party negatively in any way. There's no other tax consequence to the other party. It really is a benefit just to the person who's trying to defer taxes and increase their ultimate wealth.
That's right.
Man, there's some other questions. We just ran out of time, dude. I can't thank you enough for spending today with us. And if you have any questions, please feel free to reach out to Craig. Craig, we're going to put your information in this this link, but how do people get a hold of you?
The most efficient way to reach out, just shoot me an email. Craig.brown@IPX1031.com. Shoot me an email. We can schedule a time to chat. That's probably the most efficient way to do that. Obviously, we have a very nice website. It's got all types of information on it. We're going to have a conversation, and when we have a conversation, we're going to shoot stuff back. But that's really the best way.
And they have a newsletter too, so sign up for the newsletter. Craig, I just want to tell you thank you. From my family to you. We started working together back in 2007, and is one reason why we were able to build our building here in Lafayette. So. Thank you for all your help over the years. And, if you're looking for someone who is an expert in this field, somebody with almost 30 years of experience, Craig is your guy. There's lots of people out there that can do this, but not so many people who know it as intimately and is so much an expert as Craig is. So please give him a call. And, thank you again, man, for taking the time. And, our next our next meeting is about how to make more money on your buildings and cut the utility bills, make it efficient.
That's right. There you go. Green building, baby. Yeah. There you go. Jim, thank you for the opportunity. I really appreciate working with you, and thank you for the questions you asked. This really went really smoothly, just because you know your stuff, and it really helps push that along and have a good dialogue. So thank you for that.
Absolutely, man, and we'll be in touch soon.
Perfect.